Welcome to our special edition of Market Masters, where we get you to meet exceptional talent on Dalal Street as also globally. Our guest today is an individual who spent nearly 4 decades analyzing trends, buying stocks not only locally but also internationally. Let me introduce you to Mr. Ajit Dayal. He's the founder of Quantum Advisors, which is the sponsor of Quantum Asset Management Company. Mr. Dayal, it's indeed a pleasure and an honor to host you, sir, on Market Masters. It's rare to find people with this kind of an experience, both locally and globally, to grace our show. And I'm sure the next 20-25 minutes are going to be really exciting and a learning curve for not only our viewers, but to me as well. Welcome, sir.
Joy to be here. Thank you so much for that very kind introduction. Thank you.
Okay. So Mr. Dayal has worked in a lot of Western markets, including the US, Canada, as well as the UK markets. And we'll begin with asking him the problems that the global markets are facing. Mr. Dayal, we have problems on the 10-year US yield, which is at its highest since November 2007. Inflation has reared its head globally, and supply chains are still not active. On top of that, we have this conflict in the Middle East, which is creating a lot of problem for equities across the board, especially in Asia. How are you analyzing this market globally, and what do you think would be the immediate effects over the next 6 months?
So I'll first go back a bit in history, right? We talk about the principles of finance and the principles of investing. One of the most important principles is risk and return. And there's the divergence between playing with your money and allocating your capital. And when you're allocating capital, you're actually assuming there is a cost to idle money. And what we've seen since 2008-9 after Lehman has been this assumption, and a whole generation of investment managers, a whole generation of portfolio managers has grown up in an environment where they were looking at investing money. And why? Because there was a lower interest rate environment where there was no discipline for the money that you kept idle and was kept in a bank or in a government bond and earned you an interest and became capital. And what we're seeing now is a reversion to the mean. We're seeing interest rates around the world, particularly in the US, increasing to a long-term average of roughly 5% after being for a decades plus, 2% and sub 2% number. And what you're seeing really is this reallocation of mindset where idle money can earn you 5%. And that then makes you allocate your capital to more carefully around the world. So that's the most important thing, I think, that not only are interest rates increasing, but that interest rate increase is forcing people to think about where they should allocate their capital in a more sensible manner, and goes back to that initial principle of risk and return. If I can get 5% in dollars in a US bank account, why should I be encouraged to put money in the US stock market, or in the European stock market, or in the less developed, though emerging countries like Indian and Chinese stock markets? And you start begin to think a little more disciplined, a little more sensibly, and a lot more long term. And I think that's the big dramatic change that you're going to see in the world, where the US pensions, the sovereign funds who've been distributing their sort of money around the world are now going to start allocating capital in a more sensible, methodical manner around the world, including to places like Indian equity markets.
Well, from what I read between the lines, are you trying to imply that this 5.75% rate of interest that we see, which is also the longer term average over 40-45 years, is here to stay in the US, as also is inflation? Because from what we hear on a quarterly basis from the Fed, it says that so far we have controlled inflation, and from now on things are going to look better. And the same statement is repeated after 2 months every time.
Correct. So, the near-term objective of the Fed is to obviously bring inflation down. The long-term objective of the Fed should be, they've not stated it, but it should be to ensure that there's at least a 2 to 3% differential between interest rates in the US or in global developed markets and the long bond or the 10-year bond in those markets. And if the Fed picks that as a policy, then capital allocation is here to stay. But you're right, for now, their immediate objective is how do I bring interest rates, inflation down by bringing up interest rates, as opposed to their long-term objective should be how do I ensure that capital is allocated in a sensible manner. And I don't know if they'll ever make that, if they'll make that shift. That shift was last seen when Paul Volcker was the Fed chairman in 1979, 1980. Ever since then, every central banker in the US, Alan Greenspan started it, has basically been, what Ben Bernanke called helicopter money. If something goes wrong, turn on the tap and throw money at it and try to solve the problem, whether it was a Lehman crisis or whether it was the Bernanke twist or whether it was COVID.
And the fact that the US Fed is now held to ransom by the Wall Street is, of course, now pretty well known. Mr. Dayal, the last time we talked to each other, it was a different era on Dalal Street and a different kind of Indian market from what we see now. Not only have institutional participation deepened here, but the retail is coming back as if there's no tomorrow. Your funds are beneficiaries of this wonderful 16,000 crore rupee monthly SIP coming in. And the granularity of the market has changed from what it is now compared with 10 years ago. How do you see the trajectory of the Indian markets from now on? And what do you think has changed for the better?
So over the last 40 plus years, you've had the BSE 30 index, which began at 100. And I look at the BSE 30 index still, I'm not still a Nifty person per se. That shows my age. But you've gone from 100 in the index in 1979 to 60,000 plus. So you've got this compounded rate of growth of 18, 19% in the BSE 30 index. And if you look at the total return index, which is dividends reinvested, you've already crossed a lakh. So 100 has become, 100,000, 1 lakh. And in our view, for the next couple of decades, India will continue to have that fantastic tailwind of higher GDP growth rate, which will give companies in the economy an opportunity as they serve their customers globally and international and locally in India to make more profits. And more profits, we know, as we've seen, always results in higher share prices. So I'm glad that Indian retail investors are finally moving en masse to the Indian market, as opposed to we just had a few people, as you indicated, over cycles. And we hope that this is a long-term, structural, secular change of people investing in mutual funds or directly in stocks. But if you're going directly, be extremely careful what you do. But of moving money towards equity markets, because this is the story, in my view, of the decades-long story for India on a global basis. A fantastic place to invest. This is our home country in that sense. So yes, keep on investing, but keep on being extremely sensible and careful as to how and where you invest. And I go back to risk and return and happy to talk about how Quantum Mutual Funds sees itself as being one of the service providers to the investors and a platform on how we believe we can make you a thoughtful investor and a sensible long-term investor.
Okay. Mr. Dayal, let me just bring up for our viewers something which is really exciting. There is a small cap fund launch from your stable at a time over the last 4 or 5 months that we've seen the small cap index give a return of about 36, 37% over the past 4 months. Aren't you a little late to the party?
So when we launched the Quantum Value Fund in March 2006, the BSE 30 index was at the then peak of 6,000. And, if I was here in front of you on a show, you'd have said, oh, Mr. Dayal, aren't you late in March 2006? And the answer is, yeah, we're late. We should have launched the small cap fund before. We should have launched the value fund before. We did not launch the value fund prior to March 2006 because that's when we got the license. And of course, from a BSE 30 index of 6,000, today we've got an index that's grown up by 10x. We've got the NAV of the long-term value fund from 10 rupees up to 94 rupees approximately. So at that point in time, it looks like, yes, you're late and the market's peaking. But like I said, you've got this fantastic tailwind of growing economies, growing company profits. What the question to ask is, when we get the capital, are we going to rush into the market? Do we really have a methodology? We do have a proper methods to pick our stocks, to build a portfolio for the next 10 years, as we did for the long-term value fund? And the answer is we'll do exactly what we did at the time of the value fund launch. We'll wait. We've already have a list of stocks we know we want to buy, and we'll buy them at the prices that we think make sense. And we will ultimately, over a cycle, deliver, as we have done in other funds, what we call superior risk-adjusted performance. Again, I do not want to compare ourselves with benchmarks. We know by law, we have to have a benchmark. We have a lot of disdain for benchmarks because benchmarks do not look at the character of the underlying company. They don't look at how good or bad the company is in terms of corporate governance. Benchmarks are chosen for large, liquid, viable stocks. A large, liquid, viable stock may be run by a founding family member who we don't trust. So we don't care how large and liquid it is or even profitable it is. They have an integrity screen in our system of choosing stocks in the portfolio. And that integrity screen and valuations is what will guide us to build a portfolio for the long run.
Mr. Dayal, since you've seen more bull and bear cycles than me, but one thing is very clear to me, that if a clutch of AMCs is launching the same kind of funds at a time when markets have rallied very sharply, in hindsight of course, it basically points to an interim peak or a peak in that particular sector. We've seen that happen in 2008 in the infrastructure space. We've seen that happen in 2000 in the dot-com space. And the market is littered with these examples, as you would know better than me. When you look at the small cap universe, do you really see multi-bagger kind of returns coming in over the next 10 years? As you point out, value moved from 10 rupees a unit to 94 rupees a unit. Is that kind of a growth coming in India?
Well, again, I'll go back to there are two quick questions that you asked. One is, are you just launching a fund for the sake of launching a fund like everyone else? When we launched the value fund in March 2006, the first NAV was created, the inception date. We also had Reliance. I'll give the name out there because Reliance doesn't exist anymore. But Reliance launched its fund and raised 5,000 crores. And we launched our fund and we raised, I think, 9 crores or something like that, because we never used distributors. We went direct to investors. That 5,000 crores a decade later was a lot less than what our 9 crores became into over time. So they were asset gathering and they lost capital. We were asset managing and we won clients' money and confidence over time. And I don't remember the exact numbers, but I think their AUM declined dramatically. And our AUM, from a low base, of course, increased quite dramatically over the next decade. So just because someone else is launching a fund doesn't mean it's good or bad that we're launching it. We're very clear that in our suite of offerings to retail investors, we have it like a triangle. In our suite of offerings, a small cap space is right at the top. It's a risky asset class. Risky asset class, this is to your next point, risky asset classes must have higher returns. If the value fund is at the base of the pyramid within the equity allocation, I should get a lower return for taking less risk. As I go up the curve, mid-cap funds, small-cap funds, venture capital funds, not that we have one, but those will have the highest risk. And for the risk you've taken, you deserve to get a higher return. So yes, one would expect that if we are true to our portfolio construction parameters and our valuation criteria, then a small cap fund from Quantum should give you a better return than a quantum value fund because they're taking larger risk. We do not and cannot and will not forecast returns. We cannot. At least on TV, we cannot for sure. So we can't give you a number. But you should be disappointed if you are an investor in any small cap fund, and if that small cap fund has not outperformed a large cap fund from that same family of from the same mutual fund house.
Right. Mr. Dayal, let's just shift gears and come back to the Indian market. Structurally, a lot of changes have happened. PSUs were the flavor in the 1980s, the 1990s. They were A group stocks, and suddenly, for the previous 15 years, they just disappeared from our investing radars. There's a comeback of sorts happening, led by PSU banks, especially the smaller variety, as also, the railway and the defense theme have come back. How do you look at these? Are these bad pennies that have, turned to gold or silver for a brief moment? Or is there time under the spotlight given the kind of tailwind that is coming from the budgetary allocations?
So, clearly the PSUs, the reason, as you indicated in the past, they were so hot was because they were the only options in many sectors, right? In the banking sector, for example, in the 1990s, the PSU banks had a 95% market share of all bank deposits, probably a 99% market share of all branches in the country, etc., etc. So clearly, if you were investing in the future of the Indian economy, you were investing in the future really by the PSUs. And as private sector grew and as private sector companies flourished, the share of bank deposits in the case of PSU banks, declined. Banks from the private sector made inroads to small towns, small cities. They got into mortgage, etc., etc. Created a new class of retail club buyers of their product. So yes, unless the PSU banks or the PSU entities, whatever they may be, unless they change and gear up to market reality, they will just remain as, flavor of the month, flavor of the season. But for them to be part of a secular trend, they clearly have to change the way they think. They have to change their offerings and change their mindset. Now, easier said than done, because many of the boards are basically loaded with basic government nominees. So unless you have a government that allows these PSU entities, whether banks or otherwise, to be more independent and not to hold them to scrutiny for every single error that they may make, the PSU story could remain a seasonal story. But there will be, and there have been, dramatic changes at some level. So if I look at State Bank of India, I think State Bank of India has changed dramatically. I see year to date is down 3%. But you know what? It's had a dramatic change in the way it's approaching business. Is that good enough to outperform an ICICI Bank, an HDFC Bank, etc.? May not be, but certainly to match the performance and match the stride, yes, it could be. We've also read the papers recently that we may have 3 PSUs shut down in certain sectors of the economy, and that's caused their share prices to come down. There are certain PSUs like ONGC, which are never allowed to unlock their value because there's a cap on their selling price to their end users and their end customers. So there's a lot of issues with PSUs. Should you have a large exposure in the PSU sector in your portfolio? No. But clearly you can find some elements, and that's what we do and the Quantum Long-Term Value Fund, is that we look for a catalyst for a re-rating. I remember we bought the oil companies way back when, and we said, okay, one day the government will have to be forced to ensure that oil companies get a market price. And sure enough, that happened, and it was partial, but the market began to price it as if the oil companies could sell oil every day at a market price. And that was not the government's intention. And the share prices went up a lot and we sold it because it did not match the reality. So yes, you can and you should look at some PSUs, and I'm sure your fund manager is too, but you have to recognize the risks that are in there and the opportunities too.
Yeah. Mr. Dayal, as you know better than me, the Lal Street is a place where, investments start on hopes and they mature on stories, and then you sell off when these stories become widespread and well accepted. And I'm sure a large chunk of the PSU space is now in that area where easy money has definitely been made, and from now on we look at performances. Should you wear a pair of binoculars, Mr. Dayal, and look at a 10-year period of the Indian economic history from now on? Where do you think money will be deployed, both locally as also by your friends from overseas? Because probably India is the only island of safety and the bright spot that we see globally at the moment. Where is fresh money coming in, and where should it be deployed?
So I think publicly listed stocks, the equity markets, are a great place to be as an allocator to India. The other space on an asset allocation basis, of course, would be things like real estate and then private equity and then venture capital. So that's the spectrum of where we go. If I look at sectors in the economy that are likely to continue to do well or will do well over the next decade, it remains the same. There's really three stories in any economy, and the three stories are and if I give you the answer for India specifically, one is the consumption story. On the consumption story, we've already seen a whole host of companies who have grown from pretty much nothing. I mean, what was the market cap of a Lever or a Nestle or a Marico or a Dabur, 20 years ago to what the market cap is today? Those sort of stories will keep on, and there'll be new companies that will be born. There'll be a DMart, etc. There'll be new companies that will be created. At the other side, you've got the infrastructure story. India certainly needs more railways, more roads, although I think we're spending too much money on roads and should spend a lot more on public transportation systems like railways or metros. That's another discussion. But you've got the infrastructure built out, the ports, the airports, etc. And then finally, you have the export story. So if you look at Bajaj Auto, who would think that 25, 30 years ago that they would compete with the foreign firms in their own markets or closer to those companies' backyards by exporting roughly 20-25% of their total sales to international markets. And then, of course, you have the Infosys and the TCS and the Wipros who've got 80-90% of the revenues coming from international markets. So those are, again, also export stories. So India, luckily, being a subcontinent and being such a diverse economy, has all three engines moving in its favor. And it will take some really ridiculous government policy, more like shooting ourselves in the face and the feet and on our head to basically to kind of mess up. If governments remain calm and if governments stay out of detailed policy making and just leave us to take this wonderful advantage as they have from 1980 to now, we've had 10 governments grown at 6.2% per annum real rate of growth in GDP. And we believe we'll grow another 6.25, 6.5% per annum over the next decade. If we continue to have this, then we're in for a beautiful ride. And just think about who you trust to actually allocate your money for you in the markets. Select your mutual fund carefully. Go to a financial advisor. Make your financial plan in a very sensible way. And then select the mutual funds that fit that based upon what you discussed with your financial advisors. I think, it's difficult not to compound and create wealth with such a phenomenal tailwind behind us, in my opinion.
And Mr. Dayal, since both of us, at least you've seen 4 decades and I'm about to enter my 3rd decade in the market. Yes, this is the time that we waited for since at least 1990s, where a Goldilocks kind of a scenario exists for India. And not only is the runway fairly long and fairly strong, it's the huge tailwind that's coming behind this airplane that's waiting to take off. Let's just focus on how quantum as an AMC has performed over the last couple of years. It's much to do with your investment philosophy, I get that. But returns for longer term unit holders in several of your funds have left much to be desired. Would you like to defend this performance or this underperformance that we've seen relative to the rest of the market and relative to your peers?
So I will not defend it, but I will take pride in it. I will take pride in the fact, and again, this goes back to my history and to my learnings. When I first started off in the Indian capital markets and I set up Quantum in 1990, we had a joint venture with a group called Jardine Fleming from 1992 to 1995. And we were the first FII joint venture in the country then. And over there, when I was managing money, it was shooting from the hip. There was no approach to managing money. It was just like something's moving, run with it and keep on shooting in that direction. Something changes, go somewhere else. There was no methodology per se to how we were managing money. When we had a partnership with Tom Hansberger, who was a co-founder of Templeton, Galbraith, and Hansberger, now known as Franklin Templeton in the world and in India, he taught us value investing. He taught me and my peers and my colleague Subbu. Subbu and I have worked together now for 26 years. We are the longest tenured investment team in India, probably second in the world after Warren Buffett and Charlie Munger to have worked together in this field. So he taught us how to think about capital allocation, risk, and return. And before you chase the return, you first define the risk you want to take, and then you see as that risk giving you the return that you should get based upon the theory and principles of finance. The first thing we did after we broke the joint venture with Jardine Fleming in 1995 was create something called the integrity screen. During my days with Jardine Fleming, I had the misfortune of investing in some very crazy managements and strange managements who felt it was their God-given right to take money from minority shareholders whenever they felt like it and not treat even a person with one share with the same pro rata respect as someone with 1 million shares or 10,000 shares or 1 lakh shares. They felt that, oh, if you've got 1 share and if I've got 100 shares, I deserve 100 times more reward from you. That yes, mathematically you do, but proportionally you don't. You have the same rights over that. So we've not bought any shares in companies like Vedanta, Reliance, SR, Adani, etc., etc., etc. since 1996. They don't make it to what we call the integrity screen. That integrity screen has now turned into what you in the world and we in the world call ESG. We focused a lot on governance, and those companies and many other companies did not make the cut. So when I compare myself to peers, or when you compare yourselves to peers, us to peers, you should first recognize what is the risk that they're willing to take in the returns that they have given you. We've taken away a lot of risk, and risk is not volatility. As you know, being in the market, I'm happy to hear that you're now crossing over to a very long tenure too. But volatility is not risk. Volatility is the up and down movement of something. Risk is you buy shares in Ranbaxy. Ranbaxy shares sells the company to a Japanese firm, and the Ranbaxy founders get 30-40% more for their shares than you get. Although when Bhai Manmohan Singh did the IPO, everyone's risk was the same. And of course, the management must get more, if you are a founding family member working in the company, of course, you must get more salary, you must get a bonus, you must get ESOP, fair enough. But when you're selling your share, and I've got my share as a passive, quiet investor with 100 shares, we should get the same value for the share. But somehow, if that management team or that founding family believes they're superior, we're never going to touch them again. So we take away risk and we give you a return for the risk that we've not taken, and corollary for the risk that we have taken. So I'm extremely excited and happy about the return that we have generated. We're not out there trying to get the highest return. We're trying to build and have built a platform for those long-term, sensible, thoughtful investors who fully recognize risk is not up and down movement of something, but risk is making sure that when you shake someone's hand and you get your 5 fingers back, you count them and they're actually 5 fingers, and they're not 3, and they're not 2, and they're not 1. And if they are 3, 2, or 1, you please don't shake their hands again. We made enough mistakes. We've lost a lot of limbs in the process, believe me. And, we learn. But when we learn, it goes into our process. It goes into our process to ensure we don't make that same mistake again. We have the right to make a new mistake and learn from it. But we have built, and please look at our track record. It's there in our annual report. We show a grid of risk and return of all our products. And they're on this wonderful principle, investing finance 101, risk and return in a way that's upward sloping curve. So I would encourage you to really help us create a generation of thoughtful investors, not sattawalas. They may as well go play batka. It's more fun.
Mr. Dayal, I agree with you wholeheartedly, but as you know better than me, every generation of fresh investors that comes in brings in zero acceptance of risk, and all they want is returns. And then they burn their fingers, and then life begins anew in markets. My final question to you, sir. If we don't shoot ourselves in the foot, in the mouth, or on another body parts, where do you see the Indian markets in terms of the Sensex or the Nifty, say 2 years from now, 3 years from now, medium term?
Yeah. So I don't know. I can tell you the compounding will be roughly 15% per annum in rupee terms. I think you'll get a compounding rate of 15% per annum in general in the stock market. If you're in small cap, you're taking a higher risk, you should get a higher return. But I think among the large cap space, you should be getting a 15% compounded return. We've had 18% compounded over the previous 40 years. So a 15% compounded rate of return is a very nice number on a larger base in terms of where we are as an economy. Again, I just want to clarify. I think that it's not that India's in a Goldilocks moment only today. India has been in a fantastic upward movement since 1991 July, when Prime Minister Manmohan Singh, when Finance Minister Manmohan Singh, along with Prime Minister Narasimha Rao, went through the Indian reforms. And we've had setbacks, we've had issues, we've had problems politically, socially, etc. But I think, like I said, if governments just stick to that very broad plan, let business people run businesses, and let us do our whatever coalition politics we've got to do. So as long as governments leave us with that, we're absolutely fine. We have the risk, don't get me wrong. What's happening, you spoke about Israel, Gaza, what's happening with these blocks. You've got Russia, China, Iran as one block. And you've got India having to make a decision. Do you want to be part of the thugs of Russia, China, Iran? Or do you want to be part of the lesser thugs in the Western world, the more transparent thugs in the Western world, maybe, of the US, Europe, etc., etc. So those are geopolitical choices which will have an impact on us. But standalone, as an isolated entity, India looks fantastic.
Right. And with that, Mr. Dayal, we'll call it time. It's been a wonderful 25-30 minutes listening to your very varied and excellent views on how to construct portfolios, how to measure risk, and how to look at India over the longer term. May your next 40 years be better than the previous 40 is what we wish you with. And thank you so much for your time.
That's very nice, Vishal. Thank you so much. Thank you very much.
What a pleasure, sir, to host you. That, ladies and gentlemen, was Mr. Ajit Dayal for you. He's the founder for Quantum Advisors, and over the last 40 years has been investing very, very deeply and very, very profitably in the Indian markets. Thank you for watching us. Remain glued to Business Today Television for all your financial needs as far as news and updates are concerned. Thank you so much.
If you like the video, do like, comment, share and subscribe.